Nothing quite grabs investors and client attention like volatility, in particular in the downward direction. Technically, market volatility is the rate at which security prices rise or fall. Rising security prices that happen quickly tend not to bother anyone. It's the downward movements in volatility that really captures people's attention. And not only is it a very emotional time when asset prices are fluctuating rapidly, but it also creates a lot of opportunity. And so what we're going to talk about today is what volatility is, what's going on now in the present markets, but then also the things you should be doing to prepare for future volatility and the things you should capture in a volatile market. Some of them are very concrete, very practical recommendations that hopefully can add some value to your retirement planning here today. So volatility. There's different types of volatility, and it comes from different places. And I think there's actually different types of quality in terms of there can be really bad volatility, and there can be volatility that actually helps you quite a bit. One of the primary sources of volatility is from economic data. This is what I would call systemic volatility, where there's some type of systemic problem in the economy. It could be from the jobs report, inflation figures, GDP. Back in 2008, 2009, in the Great Recession, right? It was default rates on mortgage-backed securities. Economic data is a major driver for volatility. In general, the volatility tends to occur before the economics get bad. So investors and Wall Street analysts are always looking ahead and forecasting of what they expect to be happening in the next year or 2 years. And so in general, the volatility is usually occurring when the economy is fine, but looking forward, people are expecting it to be far more challenging. The economy right now is actually doing quite well, but looking forward 3 months, 6 months, 1 year, it's far less clear what that could potentially look like. Now, the source of volatility is monetary policy. Obviously, the Federal Reserve has a mandate to try to peg inflation around 2%. And as part of that mandate, they control interest rates. Interest rates function a lot like gravity in financial markets. They kind of pull everything down. If the rates go up, asset prices fall. If rates go down, asset prices go up. So Jerome Powell, as he's making announcements and determining what direction the Fed's going to do with rates, that can increase volatility. A lot of times, the Federal Reserve volatility that's created is usually in the upward direction. The reason I say that is if you look at like what happened during COVID, there was a 34% market decline during that time period. And then there was a lot of volatility straight back up based on fiscal stimulus. There was a bond buying program and interest rates were cut. So monetary policy has a big impact on volatility as well. Those two up top, I would say, are much harder to take advantage of than market psychology, which we see here down the bottom left. Market psychology, volatility can happen when people start to sell and contagion occurs, and then there's a lot of fear and people start selling, but there's no like underlying reason in particular for why that's happening. That's more rare, but a lot of times when things are healthy, things are good, and you see this market psychology where fear is spreading among people, you have an opportunity to make purchases at that time that can be quite advantageous. And last but certainly not least, a major creator of volatility are geopolitical events. This could be elections, it could be wars, it could be pandemics. So all these things create volatility. But what I wanted to focus on today is kind of what we can do to capture value during these volatile markets. One of the things that's really important to note, and we try to make this really, really clear with all of our clients and everyone that we talk to and work with, volatility really is the price of admission for participating in market returns. There's a really famous quote by Charlie Munger. He was the vice chairman of Berkshire Hathaway, billionaire. And he basically said that if you're not willing to see your equities or your stocks fall 50% in value in a single year, then you're not going to be able to participate in the wonderful wealth creation that stocks provide. In our opinion, volatility is not something that you can avoid. It's something that you prepare for. When the market drops, it drops. If you're invested in the market, your portfolio is going to drop. I do not think it's rational to try to navigate and avoid those in this entirely because you want to participate in the market year in and year out, which means volatility is the price of admission. So I think having that temperament is a major, major first step in saying my stock portion of my portfolio is going to be volatile, and you need to prepare for that in terms of what it looks like. You can see here some of the volatile events that have happened over the last 50 years. 22% decline in a single day back in the 1987 crash. This was recovered within 2 years. The dot-com bubble, PE ratios were incredibly high during the internet boom, and there was a 50% drop. Again, a full recovery by 2007. The financial crisis, which was probably one of the steepest since the Great Depression, 57% decline, surpassed its prior peak by 2013. Then you look at COVID, there was a 34% plunge, fully recovered in 5 months. I think one of the things that's really challenging for people in the midst of these drops is understanding that the recovery will occur. The number of times that we field phone calls or talk to people that think, hey, maybe this time's different, everything's going to zero, it's way more common than you would suspect. Understanding that these declines do occur, there's opportunities to capture when they occur, and staying invested is important, is by far the most valuable thing you can do through this. For example, if you sold at the bottom in the financial crisis, you probably have half your net worth that you would have if you had just done nothing. So volatility is going to occur. It's important to understand that. It's important to prepare for that. And it's also important to design your financial plan, your portfolio, and your tax strategies around the fact that volatility exists and it will occur. So let's talk specifically about some of the things that you can do to be prepared for volatility and take advantage of it. The first thing really does come on the preparation side. You want to be diversified in the way that you build your portfolio. So you want to have a geographic diversity because when you have global volatility or just general market volatility, if you are diversified across geographies, you're going to fully recover. Where you can run excess risk is if you are concentrated too heavily in a single geography. And for example, if you're part of a country that has an extreme recession and doesn't recover, so you have overexposure in international markets in that way. Or if you're wholly domestic and the only thing you own are US businesses and the US struggles for a decade, 2 decades, whatever it may be, you want to have geographic diversity to be able to weather those storms through the volatility. This is also true for sectors and industries. You don't want to own just the Magnificent Seven, because if anything were to happen to those particular businesses on the regulatory front, growth rate slow or whatever it may be, your portfolio could get adversely impact more disproportionately than others. Where if you're diversified across market caps, sectors, industries, and you have balanced exposure across the entire economy, you will participate in those recoveries when the volatility ends, and you're not going to be overexposed to unique events. Probably the most powerful thing you can do to prepare for volatility is to have the right asset allocation. And what we mean by that is investing in the right asset classes based on your unique goals and objectives. So you want to have an appropriate mix of stocks, bonds, alternatives, and cash. The way that we approach this is actually by communicating with clients and demonstrating every single year, if the market falls 50% this year, this is how your account will be impacted. And it looks very different depending on what percentage you have in each one of these asset classes. So in order to build a diversified portfolio, some practical steps you can take is to make sure that you have a core equity position that has low-cost index funds and ETFs that are highly diversified. Then for your defensive assets, we highly recommend short-term bonds, cash, or real assets. Short-term bonds here, I do want to emphasize, because when you look at volatility as it gets created, short-term bonds are going to mature faster. They're less impacted by interest rate increases. Whereas if you own long-term bonds, depending on the nature of what's creating the volatility, those actually can fall tremendously in value as well. So while long-term bonds may appear to be defensive assets, you have to be really careful with that. A tangible, practical example of that would be, let's say that tariffs increase the rate of inflation over the next 2 to 3 years. It's extremely possible that that could occur. In response, the monetary policy may change and interest rates rise. Now you see volatility in the stock market because we're fighting inflation. We may have a recession. Volatility in equities is going to occur. Prices pull back. If your defensive assets are long-term bonds and interest rates are rising to fight inflation, those are also going to fall in value. And depending on the duration of the bonds, they can fall a lot in value. So you want to make sure you understand what your defensive assets are, how you're holding them, and how they're going to respond to different types of market situations. The other thing that we highly recommend is having a quality focus. Through 2008, through 2009, I think this became like really apparent. There were so many businesses that were defaulting and going bankrupt during that time period that if you had a portfolio where quality was not your focus, it became very difficult to sleep at night. It's also very difficult to make the right portfolio adjustments because you don't know which companies are going to survive or not survive. Are you selling things at the bottom? And when you own low quality businesses, or maybe you own preferred stock that's dubious, or you're invested in junk bonds or whatever it may be, during very, very difficult economic times, those asset prices are going to fall disproportionately. And then when they do, what makes it very challenging is you have to decide, do I sell at a loss because they may go bankrupt? Or do I try to hold on for the recovery? So you're not sure if you're going to hold on and go to zero, or if you're going to hold on and you're going to recover. When you have a quality focus and you're tilted towards highly profitable businesses, highly profitable stock ETFs, you're tilted towards investments that have really strong balance sheets, and you focus on these quality factors, what happens during volatile markets is as the prices decline, you know you're going to be participating in the recovery because bankruptcy is a total non-issue. You can stay the course with confidence. Not only that, you can make adjustments to your portfolio to buy some of the assets that have decreased in value but are of exceptional quality. So that's a very, very important point when you talk about constructing a portfolio to prepare for volatility. A quality focus is really, really valuable to help behavior through those times. And last but certainly not least would just be general risk management. We talked about being highly diversified and the value of that. So I'm going to give a practical example here at looking at how asset allocation can dampen volatility. Back during the COVID crash of 2020, if you were 100% invested in stocks, your decline in your portfolio would be this red bar here on the far left. That's a 34% decline, top to bottom, during COVID. If that's something that's outside of your comfort zone, then when things are good, you should be looking at your portfolio, modeling a 34% decline, and look at, okay, if stocks fall 34%, how much will my portfolio fall? And am I comfortable with that? By contrast, if we look at the center bar here, this oranger color, this is a 60-40 portfolio. So again, stocks are down 34%. You're 60% invested in stocks, but you have 40% in short duration defensive assets, whatever it may be. Typically, we would recommend a bond portfolio. With a 60-40 mix, you're down 20%. So you've actually mitigated almost half of the decline with a 60-40 mix, and you're still participating quite a bit in long-term market returns. And then you compare that to a 20-80 portfolio, we consider this a bit more conservative. If you were 20% stocks, 80% bonds, you only have a 7% loss during that time. And actually, having this portfolio can open up a lot of opportunities to capture as things recover. So this gives you an idea of how important asset allocation is. And one of the things that I would do on an annual basis is take a look at your portfolio, multiply the percentage that's in stocks by minus 40% or minus 50%, because that kind of volatility happens in the world. That prior slide we had, it was almost every 10 years, something like that occurred where there's a very significant decline, and say, can I live with this? Am I comfortable with this? And is it okay? If the answer is no, you need to adjust your investment allocation so that when you multiply the stocks by minus 50% and you add the bonds, you're comfortable with the decline. I think that if you don't do that, when it does occur, you're going to be extremely uncomfortable and you can actually behave very poorly through that time. We end up selling when things are down, and you're making these asset allocation adjustments based on your risk tolerances at the worst possible time. So asset allocation is super important, really helps to dampen drawdowns and to mitigate volatility in a really big way. Next up, we have action number 2, which are portfolio adjustments. Depending on your asset allocation going into highly volatile markets, you actually can have an opportunity to come out on the other side with a significantly higher net worth. So one of the things that you can do is, let's say you have a 50-50 stock and bond portfolio. By introducing systematic rebalancing through really volatile markets, you actually end up automatically behaving in a way that is very intelligent, which is buying low and selling high. As an example, if you had 50% stocks and 50% bonds and the market fell 30 percentage points, you now may have 40% stocks and 60% bonds just because your stock allocation has decreased in value. If you rebalance back to 50-50, what's going to end up happening is you sell bonds out of your 60% portfolio, buy back stocks back up to 50. And what you're doing is you are buying when the market is lower. So you're purchasing buy low. And what you would do is the market recovers, your portfolio is going to go from a 50-50 where now stocks represent a higher percentage because they've recovered. So maybe now you're 60% stocks and you rebalance back. When you do that, you could actually have it where the market starts at 100, falls to 80, goes back to 100. And just by systematically rebalancing, you make money in that completely flat market just by taking advantage of the volatility. So systematic rebalancing can be really valuable, and you're basically shifting more into equities as they get cheaper. We call that a contrarian point of view. But again, if you're highly diversified with a focus on quality across sectors, industries, and geographies, making those types of rebalancing decisions is generally incredibly successful. The next thing that you can do is cash management and minimizing draws. With the cash management, you can, a lot of times when we're working with individuals or clients, they tend to have their brokerage account, their pre-tax IRA, their Roth IRA, and they almost always have a checking account that has too much cash in it. And so in retirement, people have a tendency to do that for a rainy day or something along those lines. When you see high levels of volatility and the market pulls back, deploying that cash into undervalued areas can be extremely rewarding. The other thing that can be quite valuable as well is to actually change your draw behavior when you see really sharp volatility on the downside. What we mean by that is generally, let's say the market is fairly valued, things are relatively calm, and you have your portfolio asset allocation set up. One of the things that you could do during those times is actually set up an emergency reserve or a cash reserve for highly volatile markets. Let's say you set up a 2-year cash reserve. If you were to do that, that actually is long enough to overcome the COVID decline, the 1987 market crash, and many, many others, where you just are drawing off of that cash. Set that up when the market is fairly valued and things are good. When you do that, what ends up happening is when the market falls, you do not have to sell stocks, you do not have to sell bonds, and you can actually minimize your draws from those accounts because you're able to live off this excess cash balance. Obviously, minimizing draws and the cash deployment, there's a balancing act that has to occur there between the two. But making these types of portfolio adjustments, particularly the systematic rebalancing, can really increase your net worth over long periods of time. Number 3 is probably one of my favorites. This is one of the most concrete things that you can do. There are practical, tangible tax moves that you can make during a volatile market that are more valuable as asset prices fall. We're going to cover a couple of them. The first one is pretty obvious, which is tax loss harvesting. If you've never heard of this or you're unfamiliar with it, in your investment account, it has to be a taxable brokerage account. This will not work in a retirement account that's tax exempt or tax deferred. But in a taxable brokerage account, you have tax lots of investments that you have made. Even if you've bought a mutual fund or an ETF 10 years ago and it's up quite a bit, you may think, oh, I only have this one investment. Chances are that's on a dividend reinvestment program or a DRIP program, and you're repurchasing new shares all the time. Every time you purchase new shares, it creates a new tax lot. And if you look at those tax lots, when the market is volatile, so if it fell 15 percentage points in the last month, at the bottom of that, the odds that you have tax lots that are at a loss is quite high. So what you can do is actually go into your account, look at your specific tax lots, find the ones that are at a loss, sell those to realize losses, which will offset income taxes. Your first $3,000 in losses offset ordinary income. Anything beyond that offsets short-term and long-term capital gains. And then if you have more than that, you can carry those forward year in year out and continue to offset $3,000 of ordinary income every single year. That ordinary income offsets things like 1099 retirement account distributions. So it's quite valuable to set that up. Now, some important considerations with tax loss harvesting. Those tax lots that you own, when you sell one, a lot of times people want to maintain the same portfolio that they have. So if you're invested in an S&P 500 index fund, let's say it's IVV, which is BlackRock's S&P 500 index fund, when you sell that, one of the fears is that it recovers and you end up losing out on that. So one of the things you can do on the tax loss harvesting side is actually buy back a substantially similar asset, but across fund families. There's an important rule you have to be careful of, which is the wash sale rule. So let's say you sold Apple at a loss and then immediately bought it back. That's going to be a wash sale and you're going to be disqualified for tax loss harvesting. But there's a lot of things you can do where you maintain the same exact portfolio and you avoid wash sale rules. What you can do, for example, is sell IVV, which is BlackRock's S&P 500 index fund, and then buy SPLG, which is State Street's S&P 500 index fund. You end up with the same exact portfolio. You're fully participating in the market. You have no risk of missing out on upside gains. You've captured those tax losses, and because you've done it across different fund providers, does not count for the wash sale rules. So if you're looking at doing tax loss harvesting, I would highly recommend making sure that you read up on and understand the wash sale rules to make sure you don't disqualify yourself on that. But that can be a very, very valuable thing to do that saves you thousands of dollars in taxes during a volatile market. The second thing we're going to look at is a little bit more complicated, but can be way more valuable. We're going to look at tactical Roth IRA conversions. This is a little bit different than a Roth IRA conversion with some specific nuances. A Roth IRA conversion, for those who do not know, is where you take a pre-tax account, like a 401k that you've rolled over, and you're actually distributing funds from that into a Roth IRA, and you're paying taxes on that distribution. They call that a Roth conversion. These can be incredibly valuable. Depending on your situation, they can save anywhere from tens of thousands to hundreds of thousands of dollars in taxes throughout retirement. So Roth conversions is one of those things that you should have mapped out over the lifetime of your retirement, and you should have an idea of how much do I want to convert this year. The way volatility plays into this is, let's say you started this year with a strategy where you said, I want to convert $100,000 from my pre-tax IRA to my Roth IRA. When the market is volatile and it drops, doing a Roth conversion during the volatility, when the market is lower, actually increases the value of that Roth conversion, and it can increase it substantially. I'm going to show a graph here that demonstrates this with 3 different Roth conversions. I'll try to explain this here. We're going to start on the left side here where we have these 3 bars, the red, the orange, and that tannish color. The red bar represents the size of your Roth IRA conversion. So in this case, we're doing a $100,000 conversion. This also assumes that you're going to pay the taxes of that Roth conversion from a taxable brokerage account or a checking account or something along those lines. On the left-hand side here, what we are assuming is that the market is flat all year. So there's no volatility. In that case, you would convert $100,000. You would pay roughly 24%. It depends on your tax bracket and what state you're in, etc. But in that case, we're going to assume 24% tax rate. You would have to write a $24,000 check to the government to do this Roth conversion. So you pull out 100, you pay the 24,000 in tax, and now you have 100,000 in your Roth IRA account. We're going to compare this to if you do the same exact Roth conversion, but you do it when the market is volatile. So in case number 2, what we're going to look at here is where the market falls 15% and then goes back to where it was. This is actually incredibly similar to what we've just experienced. The market fell about 15 percentage points, and it appears to be creeping its way back up to break even. So this is a pretty good example for this year. In this case, let's say you were planning on doing that $100,000 conversion. Well, if the market falls 15%, that $100,000 you were going to do is now worth $85,000 because you've lost 15% of the value. If you do the conversion when it's worth $85,000, you're going to pay $20,400 in taxes instead of $24,000 in taxes. So your checking account that you're writing to pay the taxes for, you just saved $3,600 doing that conversion. When the market recovers back to where it was and your Roth IRA is flat on the year, you're now back up to the $100,000 after the recovery. So if you do a $100,000 conversion in a flat market, you pay $24,000 in taxes, you end at $100,000. If you do it in a volatile market and you do it when it's down 15% and then it recovers back, so market's still flat, it just had volatility in between, you save $3,600 in taxes. Tactical Roth IRA conversions can save you a lot of money on taxes. So having this prepared beforehand is quite valuable. Now I'm going to show a third case. This is actually the best one that you could do. Most people, when they go to do Roth conversions, if they're targeting a $100,000 conversion, they're very likely not going to convert 85,000 when the market is down. When the market drops, you still want to convert 100,000. It just depends on the size of your pre-tax IRA and tax situation. But in this case, we're going to model again market volatility, but instead, when the market drops, we're still going to convert 100,000. Rather than doing less, we're just going to convert the 100 grand into the Roth. In this case, you pay 24,000 in taxes, same as you did in the totally flat market. The difference here is because the market has fallen 15%, when the Roth IRA recovers, that Roth IRA is going to be worth $117,000, meaning by doing the same exact dollar amount, but doing it when the market's volatile, you pay the same exact amount in tax, but you end up with 17% more assets in your Roth IRA. If I had to summarize this relatively succinctly, doing tactical Roth IRA conversions when the market is low lets you get more money. Actually, I should say more assets into the conversion at better prices. It can be super, super valuable. So for those that are already doing Roth IRA conversions, adding a tactical component to this can be worth a tremendous amount of value. This idea of making tax moves when asset values are depressed actually touches probably tens, if not hundreds, of different opportunities you can evaluate. I'll give two more examples, but there are many more. Qualified HSA funding distributions, where you pull money from a pre-tax IRA account over to an HSA account. You can do this once in a lifetime. When asset prices are depressed, this becomes more valuable. Very similar to the Roth IRA conversion. Gifting assets. Let's say you are worried about your estate exemption. Gifting assets at depressed values allows you to capture more asset transfers for the same dollar amount when values are lower. There's many, many, many examples of tax moves that become more valuable as asset prices decline. So having these things prepared can be extremely valuable at the beginning of the year. So I mentioned all these different activities. One of the things that we believe is most important as you're looking to capture volatility, it is incredibly valuable to have a plan in place before volatility strikes. Rest assured, you are going to experience more volatility in the financial markets in your lifetime. Having a plan at the beginning of every year on what you're going to do and how much and why is extraordinarily valuable. The tax moves that we just discussed, if you have the Roth IRA conversion prepared, you know how much you want to do, how you're going to pay for the taxes, etc. When volatility strikes and it only lasts for 3 or 4 days, you can do the Roth conversion exactly how you have it planned and capture tens of thousands of dollars in additional value by being prepared. Mapping out your allocation adjustments. We talked about rebalancing. Let's say that during a healthy market, you are 60% stocks, 40% bonds. Having a conversation where we say, hey, if the market were to fall 25%, let's recommend increasing our stock allocation so we're buying low. And say we'll go up to 50-50. I'm sorry, we'll go up to, let's say, 70-30 or whatever it may be. Having that plan mapped out prior makes it so that as volatility is occurring, you're executing on saving money on tax, you're executing on buying additional stocks at lower prices, and when the market recovers, you've captured a tremendous amount of value. So having the allocation adjustments mapped out is really, really important. Last but certainly not least, this is definitely more challenging for individuals to do in retirement. This is something that a professional organization like Selective does. Having an opportunity watch list. We have a list of over 225 incredibly high quality businesses. They're generally debt-free, highly profitable. And we know how much we want to pay for each one of these. And they're on an opportunity watch list. When volatility strikes, you can just check that watch list every single day and see if any of these high quality investments have hit purchase prices that are really attractive. But having this plan in place before volatility strikes is probably the number one thing I would recommend to plan for future volatility that will occur during our lifetimes. These are just some of the tips and tricks I think that you can do to take advantage of volatile markets, to stay calm during volatile markets. And all of them, when you combine them together, help you to control your emotions. The worst thing that you can do in a volatile market is sell at the bottom. That is by far the worst thing. I believe that when people sell at the bottom, it's generally because they had not done the asset allocation work beforehand. They didn't understand how much their portfolio could fall. So they ended up selling at the worst time. So having the correct asset allocation, understanding how your portfolio can move before the volatility strikes, mapping out how you're going to change the asset allocation when the volatility does strike, and then what tax opportunities are we going to take advantage of. All these things, when you combine them, help you to control your emotions. This is by far the most valuable thing you can do, is have a good temperament going into these really challenging markets. Um, Again, maintaining that long-term focus is absolutely essential. So with that, I'll go ahead and wrap it up. Robert, I'll open it up for you for Q&A. I see we have some questions in the chat here, and we'll go from there.
Absolutely, absolutely. And before we jump into the Q&A, just a reminder that you guys have the opportunity to schedule a one-on-one strategy session. I'm going to drop that link to schedule in the chat one more time, just so you have it there at your convenience. Chris, I have a couple questions here. This one's more about just like kind of markets and behavior and things like that. I get pretty nervous during volatility like this. How often should I be checking or making adjustments to my portfolio in times like this?
Yeah, very, very good question. It really comes back to having a plan before the volatility strikes. So if you know your current asset allocation, you understand how things could decline with certain levels of volatility, being comfortable with that and understanding how you're going to adjust that allocation based on the volatility. If you have that all prepared, I think checking often is not a problem. You could check every single day. A lot of people do that, particularly when things are volatile, but it depends why you're checking and what checking does to your temperance. So if you're checking to see if do I rebalance now or do I take advantage of this tax strategy now, that's a perfectly healthy thing, and as long as your temperament is okay through that. But if your checking makes you nervous and if your checking is going to cause you to have poor behavior, like selling assets that you should not be selling during volatility, that could be very, very problematic. If you have that type of temperament, I would highly recommend working with a professional, because having a steadfast hand at the helm for that is going to be incredibly valuable. It's a great question. If it makes you anxious, don't do it. But if it's just something you're doing strategically to check for opportunities, I don't think it's a problem at all.
Right. Um, Next one. This is pretty interesting. And we have a lot of clients that bring these types of products to us to review. Um, I've been seeing a ton of ads for annuities and guaranteed products. How might these fit into my portfolio?
Uh, That's a good question. So that's going to circle back again to your risk tolerance and goals and objectives. I'll start off with a disclaimer here. Well, we do not sell any annuities. We are not annuity fans. In general, they tend to be really high commission products. And we think that the overall performance of an annuity, whether it's variable or whatever it may be, it's going to underperform a low cost index portfolio with the right asset allocation. So in general, not a huge fan of annuities. The commissions on those are oftentimes disguised and are very difficult to even peel back the layers of the onion to figure out what you're paying. But they can be as high as 10 or 15% of the purchase price of the annuity, which is devastating for a retirement account. However, almost everyone who's intrigued by these annuities has a common trait. They are risk averse, right? The words guarantee and receiving that income for life and not having to worry about the volatility, etc. That's what's drawing people to these, is risk aversion, right? They want something conservative. You can build a conservative portfolio, in our opinion, that radically outperforms an annuity, has significantly less in fees, way more flexibility, but is still risk averse or still matches those goals or objectives. So that's the common thread for people that are really drawn to annuities, is risk aversion. And there are other ways to tackle that, in my opinion, other than annuity products.
Great. And we got time for one more here. This one's pretty interesting. It's kind of on the planning side of things. I normally max out Roth conversions to the top of the 24% bracket. Once that's filled up, if the market corrects around 20%, is it worth exceeding that 24% bracket and going into the 32?
That's a great question. And it's a complex question. So I'm going to touch on two things to answer that. The first one, it depends on your age a little bit, because most people doing Roth conversions, I will say, are on Medicare or are age 63 and are going to be on Medicare within the next 2 years. The only reason I mention that is When you're doing Roth conversions, you're going to get hit with IRMA surcharges based on your income. So when you do Roth IRA conversions, not only do you want to be aware of what marginal bracket you're in, but you want to be aware of what IRMA bracket you're in. Now, that may not apply to this particular person's question, but we see that like 90% of the people, IRMA does apply. The reason I mention that in this particular case, especially, is going to the top of the 24% bracket is actually pretty rare in terms of like it being a mathematically good idea. Normally, you want to fill up the 24% bracket till you hit that. I think it's the second or third IRMA surcharge, and you want to stop before the IRMA surcharge because it's a cliff. And that very last amount of the 24% bracket's not worth it because you pay so much more in IRMA compared to the little amount that you're converting. So that'd be one thing I just want to mention is it's rare to go to the top of the 24. You almost always go to one of the IRMA brackets close to the top of 24. Now, that being said, let's get to the heart of the question, which is, should I keep converting more when the market is down? I think the answer to that is no. The reason is the 24% bracket has one of the largest jumps, right? It goes up to 32% after that. And that 8% delta in taxes is going to be extremely difficult to offset in the additional assets transferred at depressed valuations. It really depends how far the market falls because the larger the decline in asset value, the more valuable moving depressed assets are. So it would have to fall 10% more, roughly, to break even on that 8% increase in tax rates. Just back of the napkin. And even that's not like super clear. So I don't think you necessarily want to go into that 32% marginal bracket, but that's just it just gets a lot more challenging to navigate there.
Yeah. All right, we have a ton of great questions. We want to make sure we respect everyone's time and wrap up here. But before you go, again, just want to remind you, you are welcome to schedule a free strategy session where we can dive into your portfolio, your retirement plan, address any specific questions you have. Usually they're about 30 minutes or so. They're pretty valuable. It's a great way for us to learn about your situation. You can learn about our firm. I just dropped that link in the chat. Feel free to stick around. We'll probably wrap up here in just a minute, and send any more questions you have in the Q&A. I can respond back. But appreciate everyone joining, and I'll see you on the next one.